determinants of market interest rates. So this is a little bit beyond the narrow confines of Finance 113, but just to give us a little bit of background into interest rates. Now, modeling interest rates far more complex than this. This is what we would call a very, very simplified model of interest rates, but gets at some of the basic principles. Each one of these items or each one of these components in the nominal market rate of interest has some really, really interesting and somewhat complex modeling behind the scenes, if you will. Okay, so any kind of interest rate, which we've taken for as a given, it's just, hey, it's in the question, Magic Bunnies came up with it or something like that. And there's actually quite a bit involved here. Okay, so some of the very basic components is we start off with this thing called R star, which is just a real, means interest adjusted. Not inflation rate adjusted, real risk-free rate. There's an inflation premium, right? Because inflation erodes our borrowing, erodes our the value of future cash flows. There's a default rate, the default risk premium, what's called a liquidity or marketability premium, and then lastly, there's a maturity risk premium. Okay, so these are the basic components to what goes into determining interest rates. Okay, so R star is just simply the rate of return on a riskless security, so no risk, if no inflation is expected. So it's a real return, assuming there's no risk. Often you see government bonds of some sort used as this riskless rate because most central banks in the developed world, and mostly looking at G7 like countries, either the European Central Bank, U.S. Federal Reserve, Bank of Japan, Bank of Canada. They're riskless because those countries can just print the money to pay the debt. So there's never any chance that they'll default because they can just, print more polymer bills or print more bills, give you that, and send you on your way. Doesn't mean that's a good thing, but it's what makes it riskless. So no risk of default there. Now, this R star is not a static number. It's not, hey, this is a base number and it never changes. It does change. And over time, it has changed. And right now, with a very expansionary monetary policy throughout the world, those world interest rates are very, very, very low. Okay. Other things that may be affected beyond monetary policy is just a simple time preference for current versus future consumption, right? Savings rates works into this as well. And as we have a lot of in Canada and U.S., lesser extent in Europe and Japan, older people are, getting older, boomers, saving money. And so there's a surplus of funds flows into bonds, and so that's kind of pushing down the base rate that those bonds have to pay. Now, as time goes on, and maybe those boomers start to pull that money out, that could change. There's also inflation premium, and we're not just talking about, when we talk about inflation premium, it's not talking about inflation in the current period, which right now is fairly low, but inflation as expected into the future. Okay, and it's a really interesting modeling that goes into trying to figure out what that inflation premium looks like. But there's an expectations in there. And sometimes, we expect that inflation isn't always the same as real inflation, right? I mean, we could expect inflation to remain at under 2% for the foreseeable future because it's been under 2% for some time now. 12 years from now, 14 years from now, 18 years from now, 32 years from now, is it still 2%? I mean, really, we don't know, right? We don't expect it to be different, but, that's a long time to be forecasting into the future. And there's a default rate risk, that this is the probability or the chance that the company doesn't pay any or doesn't pay all of the face value when it comes due, or doesn't pay all the coupon payments. Right? So it's not necessarily that you lose all your money, but you could lose part of your money, right? You're just not getting a full payment. Right? And Robert Merton, very famous economist, has done a bunch of modeling, has a big paper out on, determining what that default rate risk could be modeled as, or it might look like. Clearly, the greater the probability that the company that you're putting the money in or loaning money to, the greater probability that they won't pay you back, the more compensation you're going to want for taking upon that risk, right? So the idea that a default rate risk premium exists is kind of common sense, right? If you're lending to just some guy just opening up a business right now versus Google, you're kind of thinking that Google is probably more likely to pay you than a brand new startup. Right? Who knows into the future? Google hasn't been around long. Who knows how long it'll be around? But right now, it probably looks like Google's got a lower default rate risk. And so some other things, sometimes if you're worried about this default rate risk, there's some items you can put into the bond contract, right? So we talked about the basic elements of a bond contract way at the beginning of this particular chapter. And there's things that you can, work into the bond contract to sort of maybe take down this default rate risk. Companies may do this in order so that they don't pay so high an interest rate. Also, bond investors may demand it because they want to reduce their risk as well. So one of the big things is secured debt, right? Secured means, hey, if I don't pay, you can take that factory over there, right? So I'm securing this debt or my promise to pay based on this hard asset here, and that if I don't pay, then you can take over the factory. I mean, essentially a mortgage is like that, right? You mortgage, you borrow money from the bank based on, you use your house as collateral, right? So here you just have collateral. Where unsecured debt, often it's called a debenture. It just means, hey, I promise to pay. So for instance, from a personal point of view, a line of credit is like a personal line of credit is like a debenture. I promise to pay that, and if I don't, you can still go after someone's assets. You just don't have a sort of a priority on a specific asset. Okay? Credit cards are like that as well. Then there's senior versus subordinated debt. That just means who gets paid first. So these are debt holders that are not secured on any particular asset. And now it's just a matter of, okay, given that all the bondholders who are secured against a specific asset, they get the asset, they sell the asset, and if there's amounts owing, they they can become an unsecured creditor for that excess amount, and then it's just now a matter of who gets paid in what order. So if there's some money available to pay just the general creditors or the unsecured creditors, then there's a ranking system as to who gets paid first. There's guarantees, so a lot of times there's bond guarantees. So CMHC, Canada Mortgage and Housing Corporation, often will guarantee people's mortgage. So if you have sort of a high percentage mortgage, and you get CMHC insurance, which has a premium attached to it, if you don't pay, then CMHC will make the bank whole on your non-payment. Okay, so it's essentially a form of insurance. EDC is the Export Development Corporation, and sometimes they'll do, if you're trying to sell your goods that were made in Canada or provided by Canadians abroad, EDC sometimes, in some cases, will finance that purchase, will basically finance the foreign corporation or foreign government that's buying those items, and so they guarantee that you get paid by them. Okay. There's things called a sinking fund provision. That's where you have to put a certain amount aside. So far in this chapter, we've talked about, hey, here's the face value at the maturity date. You get this big lump sum payment. Well, maybe you're not so sure that the company's going to have that big lump sum payment when the when the bond comes due. And so you require them to set aside a little bit of principal every period or at some sort of frequency, and then you have a little bit of assurance that the company will have that money available, or if they don't, they'll have at least some money available. Right? Debt maturity, it's just how longer time period, the more bad things can happen, right? And restrictive covenants, you have to maintain a certain amount of cash on hand. You can't borrow more. You can't have debt higher than a debt asset ratio above a certain level. So anything you can't borrow extra money without, or you base without our permission or whatever, right? So it could be pretty wide open and open-ended as to what's a restrictive covenant. Just anything that sort of it's like a constraint in linear programming. Anything that limits you from doing things that are not in the interests of bondholders. Paying dividends when your income is below a certain level, or things like that. Okay. It could be very, 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 very open-ended on that. Liquidity premium. Just if it's hard to sell, if it looks like it's hard to sell, then or the bond is not really easily saleable, then there's an extra premium for bondholders in that particular regard. Berkshire Hathaway, Warren Buffett's company, a lot of times they'll buy an entire issue, and they'll scoop up this liquidity premium from themselves because they don't really intend on getting into the bond buying and selling business. So they have no intention of selling the bond anyway. So heck, if you're going to hold it to maturity, you might as well get paid the extra premium, because you're getting extra money for doing something you were going to do anyway. This one's really hard to really get a good handle on as far as modeling goes. And maturity rate risk. And maturity rate risk is really comes down to that interest rate risk, right? It's that sensitivity to changes in interest rates. Right? So we may set the bond rate, but the market rate goes up and the market rate goes down, and that fluctuation creates a risk. And bonds that are longer term feel that risk even more, right? And we sort of had some examples if you roll back to some of the questions where longer term bonds, we can kind of see that the difference between the price and the face value can be quite divergent for longer term bonds when interest rates, the bond rate and the yield diverge, aren't the same. And this could be interest rate, could be positive, it could be a negative. What makes it kind of interesting and maybe a little bit more complicated is the interest rate risk is somewhat non-linear because the term structure of interest rates is a non-linear relationship. So there's some pretty cool, some complicated math that can go into that particular thing. Reinvestment rate risk is somewhat related to the interest rate risk, in that you may have a bond that pays at a very high interest rate. However, when you get paid your coupon payment and you go to put that money back into something to invest in another instrument, interest rates have since gone down. Crap, right? I mean, you got this nice investment that's paying you at a really good interest rate, but then when you go to reinvest, those coupon rates, those coupon payments, you're not getting as good a return as this other instrument was giving you. Right? So there's a little bit of a reinvestment rate risk, and that creates a little bit element of complexity in when you're trying to adjust and balance your bond portfolio. And that's just sort of the basics of the determinants of market interest rates. It's purely a optional chapter, just in case you want a little bit of teeny tiny background into how those interest rates are determined.